Hey, good morning. Uh, in this today's presentation, we shall understand securities market segments. Okay, this is a very important information, uh, both for students who are going to study in BCom or for who want to take any uh, NSC exams. But it is also very important for all the retail investor, to understand the share market segments. Let us first take the nature and definition of the primary markets. See, any security market basically consists of uh, two types. One is the primary market, and another is the secondary market. So we shall consider the primary market first. So what are primary market? See, primary markets are those markets uh, where equity and debt are raised by the companies from in outside investor. What do you mean by outside investor? Outside investor basically means investors who are not owners of the company or majority stakeholders of the company. So company tries to get the investment other than the owners and the majority stakeholders of the company. So the component which forms the outside investors are basically termed as primary markets. Now, outside investor means those who are not promoters of the company, as I have discussed. See, in primary market, investors purchase the securities directly from the issuer. So, who is the issuer? Issuer is nothing but the company. Now, issuer of securities to public or to retail investor, they can issue either equity, that is nothing but shares, or they can issue debt. Debt is nothing but bonds. Generally, corporate bonds are issued to raise funds for the company. Uh, See, these two, whether you issue equity or you issue debt in the form of corporate bonds, they are all ensure availability of long-term money and capital to the issuer, that is the company. See, this procedure of getting into the primary market by any company is called as going public. There are another method of going public. Uh, the second method is nothing but to select a specific group of investors like institutional investors, banks, financial institution, and allot them shares. This is also called as private placement. We will discuss all these terms: private placement, specific investors, who are the specific investor, in the coming topic. Now, coming to what are the functions of the primary market. So whenever we try to explain what is primary market, we should know what are the function and how does the primary market help a security market segment. See, first of all, primary markets ensure access to wider market segment. That means in a company, if the company is raised by owners by putting money from the owner and their nears and dears, or from majority investors or angel investors, primary markets will give these owners an opportunity to access retail investor. um, Retail investor will be able to give funds to the owners or the company at competitive rates. So primary market facilitate retail investors to have a stake in a company. So even retail investors like us can have a stake in a company by subscribing to IPO or FPO. IPO is initial public offer, and FPO is follow-on public offer. Uh, See, basically what I said, the company will move out of the source of primary source of funds like angel investors, venture capitalists, institutional investors, and they try to get funds at a more competitive rates from the retail investor. Primary markets also ensure a very transparent pricing mechanism. So how does it do? See, pricing of IPOs is done based on the strength of the company, um, to honor the commitment which they have given through their red herrings prospectus. So hence the prices has to be competitive. Whenever a retail investor tries to invest in a company, a lot of research is done by the retail investors in order to ensure that the money which they are going to invest in a company is a good profitable company or a company with very good future prospects. So this is applicable, transparent pricing mechanism concept is applicable both for the initial public offer and for the debt raising by the company also. See, debt raising can be done by any corporate entity and also by any government institution who are having a majority stake in a company like BHEL, Bharat Electronics, National Thermal Power Corporation. There are so many institutions manned by the government having majority stake. See, the third important function of the primary market is that it helps in ownership diversification. Whenever a company is formed, usually the majority stakeholder will be the owners of the company, their nears and dears, and some major investors like angel investors and institutional investors. Whereas when you go public with IPO or FPO, it helps in ownership diversification. So ownership diversification, what does it do? See, it separates management from the owners. So whenever a company is formed, the management, since the shareholders, majority shareholders of the company will be the owners of the company, so the management is also controlled by the owners. Hence, there will be a scope for manipulation of financial statements and other things. But whenever a company goes public and retail investors and other source of investment come, then there will be more diversification. So as a result of which we can replace the present management with a more competitive management. So ownership diversification also helps in bringing professional managers on the board to the company instead of just the owners or the majority stakeholders of the company. Uh, it will also help presence of independent directors on the board, and it will also help in ensuring better governance standards. Primary market ensures better disclosures. How does it do? See, retail investor demands greater information about the company before they invest. So this will enable investor to have a better, accurate and verifiable information about the company before investment. So the company, if they have to get investment from the retail investor, they have to give full disclosures about the company functioning, their financial position and other aspects of the company. Next is the evaluation by the investors. See, when an investor put money into any company, the company will be there will be a detailed scrutiny of the company before investing. So all the publicly available information like the financial statements, red herring prospectus come under the scrutiny by analysts, reporter, activists, and media. Another function of the primary market is primary market gives an exit route for early investors like institutional investors, angel investor, venture capitalists, and HNIs. So another important aspect, which is very important for any company, is liquidity for the security. Any stock issued by any company should have adequate liquidity in order to ensure that the shares of the company is adequately traded. Whenever a company has very few investors, it will be very difficult to find sellers of the shares or the bonds. Also, the cost of finding an investor who will be able to take on such huge chunks of equity by majority stakeholder will be very less. However, if the retail investors start participating in the security market, then it will be very easy to buy and sell shares of a company. So this increases the liquidity. Now coming to the regulatory provisions. and supervisions. Primary market has fantastic regulatory provisions and regulatory supervision. The IPO is subject to number of regulatory process before IPO is released, uh, like the issue process, who are the involved, disclosure norms, and other aspects. Now, what are the types of issue? So let us understand this. See, public issue is of two types: initial public offer. See, this is issue of shares to public by an unlisted company. It's very important. Initial public offer means any company which is not listed in the stock exchange will issue shares for the first time. That is known as the initial public offer. What is follow-on public offer? Follow-on public offer is issue of shares by an existing listed company to public is known as follow-on public offer. Another type of issue is the private placement. See, in private placement, what the company will do, the company will select certain investor uh, and invite those investors to buy the shares. But these shares are issued based on the auction or the highest bidder. See, actually, private placement is nothing but a wholesale issue of securities to institutional investors. Now, what is preferential issue? This is another form of issue. See, issue of a specified quantity of securities by any listed company to any selected investors on private placement. Private placement we have already discussed. The only addition which is happening in preferential issue is here the specified securities will only be issued on a private placement. Now we should understand that this private placement is basically done on the basis of ICDR norms, that is issue of capital and disclosure requirement regulations. Preferential issue does not include employee stock option or employee stock purchase or any depository receipts issued outside India. Now let us come to the next concept known as qualified institutional placement. Um, Issue by promoters of a listed company to a selected investors on private placement is known as qualified institutional placement. See, qualified institutional buyers include mutual funds, foreign portfolio investors, insurance companies, pension funds. So these are all, QIPs, qualified institutional buyers. The last type of issue is the rights and issue and bonus issue, which we know it is a very common thing. These are issued to the existing specified investors. There are bonus issue which is applicable to all the investors, whereas rights issue is only applicable to certain specified investors. Now, central government, state and local government also issue, you know, either debt or equity. Government raise debt through GSEC, means government securities. Uh, the rising of the funds for any company by a government institution may be short term, which is called as treasury bills, with a maturity of less than a year, and it can be a long term as government bonds, obligated securities. Also, central government raise both short-term and long-term bonds, whereas state government issue only long-term bonds in the form of state development loans. See, government security carry no default risk. It means the central government cannot default. Hence, they are also called as risk-free gilt-edged instruments. Now, coming to the next component, the it is public sector units. Even public sector units also issue shares. Who are public sector unit? PSUs are nothing but any company having a majority stake by the central government are known as public sector units. So whenever a government offers, which is having a majority stake, obviously, a portion of its stake in a company, it is called as disinvestment. The classic example of disinvestment was Air India, which was sold to uh, Tata's through 100% disinvestment. Mm, some of the bonds issued by the central government, like National Highways Authority of India also provide tax benefits. See, NHAI bonds are issued by the government to raise funds for infrastructure activities or for the construction of highways. So this is also one type of raising of funds by the central government. Now coming to the private sector companies, which we already know, see, securities market is the primary source of funds for the private sector company. See, funds are raised by these companies. Either they can issue equity shares or they can issue debt or bonds. Uh, this issue of shares can be ordinary equity shares, preferential shares, or it can be a convertible instrument. What are convertible instruments? Suppose initially you issue a debt instrument, and later that debt instrument will have a component of converting those debt instruments into equity. Those are called as convertible instruments. And a company can also issue corporate bonds for long-term debt, and they can issue commercial paper for short-term fund requirements also. Now coming to banks, non-banking financial corporation and financial institution. See, banks have access to low-cost funds in the form of retail deposits. Hence, banks does not really require to issue any types of IPO and other. So hence, they are less likely to raise funds in the form of debt or equity. NBFC and smaller banks raise funds similar to private sector companies. Mutual funds raise funds through NFO, that is new fund offer to markets, and they can be raised for specific period. That is, some of the mutual funds can be for a period of 10 years or 15 years or 5 years, or some of the mutual funds can be perpetual mutual funds. So these aspects I have already discussed in another video with respect to the complete disclosure about the all the types of mutual funds which are existing in the Indian market. Now coming to the next type of issuer, real estate investment trust and infrastructure investment trust. See, real estate investment trusts are nothing but a very big company which hold a lot of real estates, both in the form of buildings as well in the form of land, and they lease or rent it out to get revenues. So these are known as real estate investment trusts. See, some of the very major real investment trusts in India uh, is, DLF is you can consider DLF as a type of real estate REIT. Then there is Godrej Properties, Prestige Properties, and if you come to the bonds, you can Vanguard Real Estate ETF is one type of bonds. So these are all various type of real estate investment trusts and IITs which issue public offer or private placements to raise funds. They will be listed in stock market, which they can be later traded. See, compared to initial public offer, there should be a minimum higher amount of investment in REIT, that is real estate investment funds. Now coming to the alternate investment fund. See, alternate investment avenues are basically two to three types. The first is it is slightly more different than the traditional investment. Okay. Now, alternate investment fund can be in investing in distressed assets. Okay, that is one example of alternate investment. Another alternate investment is investment as a venture capitalist or as an angel investor in a very new company which is still not making any profit, but uh, they have a very high bright future of making good profit in future. So they are very risky investments. So that's why they come under alternative investment funds. So there are certain funds which invest in these type of assets. So alternative investment funds are generally privately pooled investments, and this money is generally raised through private placements because everybody does not have so much of risk appetite. Because these investment which I just explained carry a lot of risk. So very few investors have such type of high risk appetite. So generally it is done through private placements. Now, what are the types of investors? It is very general thing, so we'll just browse through it. Resident individuals, individuals who are resident of the India, Hindu undivided family, even minors can invest through guardians. Zeredo has already come up with such, brokerage options. Registered societies and clubs can do investment in shares. Non-resident Indians can invest. Persons of Indian origin can also invest. Banks, financial institutions, association of persons, companies, partnership firms, trusts, and foreign portfolio investor and limited liability partnerships. So these are all various type of uh, investors available. So institutional investors. Uh, you see, actually, for an institutional investor, the net worth should be more than 500 crore. Non-institutional investor is the one other than the retail investor, institutional investors, and qualified institutional buyer. Retail investors are those investors who does not bid for more than 2 lakh rupees. And retail individual shareholder is an existing shareholder who bids for not more than 2 lakh. Now let us come to types of public issue of shares. We have already discussed this. Initial public offer. It is the first public offer of shares by a company. Next coming, see in IPO, the percentage shareholding of the present shareholders in an IPO will come down. Okay, because the shares are issued afresh, which increases the share capital of the company. So whenever you issue share and the share capital of the company increases, the percentage shareholding of the existing shareholders will naturally decrease. In case of offer for sale is one component where the existing shareholders offer a part of their holding for sale. Hence, the total number of shares outstanding will remain the same. It will not change. The proceeds of the sale will not go to the company, but the proceeds of the sale will go to the existing shareholder who offered to release a part of his shares for sale. The best example for offer for sale is the disinvestment of PSU shares by the central government. See, follow-on public offer is nothing but additional shares are issued in addition to the IPO which was raised by the company previously. Hence, the number of shares outstanding will increase here held by the company because you are giving a follow-on public offer over and above the initial public offer. Hence, the number of shares outstanding of the company will increase. This will also change and reduce the shareholding pattern of the existing shareholder. It is common sense. We don't have to dwell much into that. Now coming to the pricing of public issue of shares. So how does it public issue initial public offer is priced? Who will price it? At what should be the price of a share? See, there is something called as fixed price issue. See, the fixed price is based on the various inputs. It is very difficult to explain what are the various components which are discussed before setting a price for a company. But it is done based on the valuation of the company in the market. So this decision is made in consultation with the lead manager. See, lead manager is a very fancy word. Lead manager is nothing but any bank which has taken the responsibility of issue of public initial public offer of share of a particular company is known as the lead manager. It is nothing but a bank, merchant banker. See, merchant banker, one good example of merchant banker in ICICI Bank can be a merchant banker. Morgan Stanley can be a merchant banker. So these are all some of the merchant bankers. They are called as basically lead manager. The next important component of the initial public is book building process. See, the basic objective of the book building process is to determine the price the retail investors are ready to pay for the security. Okay. Now, the company or the lead manager will determine a price band. A price band means a price. They know the retail investors who want to own the share of a company should uh, put their bid between 100 rupees to 200. Let us take for example. So 100 rupees to 200 will become the price band. Sometimes the company can give a floor price. So what is a floor price? The company will say that no bidder should bid less than 100 rupees. Any bidding should be done more than 100 rupees. So there will not be a price band. Anybody who bids above 100, it can be 500 also, 200 also, 110 rupees also. So the floor price will be fixed. Whenever an IPO opens, the investors will put their bids in the application. Nowadays everything has become automated, and it is paperless, through DMAT. So you don't have to put in any application now. It is electronic. uh, as discussed, the price bid should be above the floor price or within the price band. See, based on the bidding done by various investors, a cutoff price is determined when the IPO is fully subscribed. Fully subscribed means, suppose a company has issued to the market 1 lakh shares. If the bidding is done more than 1 lakh, then the uh, you know uh, company share is IPO is fully subscribed. If it is less than 1 lakh, then it is not fully subscribed. As we know, there will be discount for retail investor, but usually it should not exceed 10% of the cutoff price. See, whatever the cutoff price is determined, the discount should not be less than 10%. And also, a cutoff price is determined only when the IPO is fully subscribed. Generally, there will be reservations for qualified institutional placement, mutual funds, and other aspects. Now, let us understand how book building process is done. It's a very interesting thing, and it is very simple also. It will help you understand whenever you are trying to place your bid for IPO. So let us assume a company having an IPO share of 4,000 rupees, 4,000 shares. They have set a price band of 250 to 350 rupees. Now let us assume how the bids will come. For 300 rupees, 350 rupees price, the number of shares which is bid by the retail investor is 500. So total demand is 500. Now for 320 rupees, the number of shares demanded is 800. So the total demand will be 1300, because 800 plus 500 will be 1300. Now for rupees 300, 1500 retail investors have bid for 300 rupees. So the total demand is now 2800. That is 1500 plus 800 plus 500. Now some retail investors, about 1200 of them, they have bid for 280 rupees. So the total demand now is 4000. So the company has issued 4000. Now at 280 rupees, all the shares, that 4000 shares has been allotted, because now the cutoff price will be 280 as IPO has become fully subscribed. Any shareholders, that is the 1000 shareholders who bid for 260 rupees, will not get any shares. See, what are the regulations that IPO has to cover? See, IPO is regulated by the SEBI's issue of capital and disclosure requirement, that is ICDR, provisions of the Company Act, RBI guidelines for NIRI investors and money from abroad. And we should understand what does these regulations cover. These regulations basically cover the eligibility of a company for initial public offer in terms of its net worth, in terms of its track record and profitability. Credit rating of the IPO through an agency is also a very important component of this regulation. The company which is raising an IPO should provide a certain amount of information to the SEBI in the form of red herring prospectus. What does it include? What does the company do? What is the business of the company? What are the profit and loss details for the past 2 to 3 or 5 years? What is the operating profit of the company? What are the future prospects of the company? And how does the company propose to use these funds? See, whenever the company raise a fund, they can use these funds to write off some of the debts which they are having, or they can use these funds for the future development and for marketing. So there are various aspects of with respect to utilization of funds. So the company has to very specifically mention where are they going to use it. Are they going to use it to expand the business, expand the market, or they are going to use it to write off the current debts or pay off the current debts? And the number of shares which are going to be issued, and what is the price band. See, all these components should be present in the red herring prospectus. See, first of all, a draft RHP is issued to the registrar of the company, SEBI and stock exchange. The IPO has an opening and a closing date. Also, an IPO should have a minimum subscription. The IPO will open only after 3 working days once you register. See, once you register your company for IPO and the registration is approved, once the registration is approved, the IPO will open 3 days after that. The IPO should be open for at least 3 days, but it should not be open for more than 10 days. Now, allotment issue. See, basis of allotment post closure of the subscription is determined by the merchant banker, as I have discussed who is a merchant banker, along with stock exchange, transfer agents. Whereas in case of oversubscription, proportionate allotment of shares as per category will be made. Now coming to the listing of issue. See, an issue can be listed whether at a premium or a discount. Uh, in See, this premium, it will be listed at a premium when there is oversubscription, and it will be listed at a discount when there are under subscription. In case the company wants to revise its price band depending upon the demand for its IPO, the issuer will increase bidding period to 3 more days. However, in spite of increasing the period to 3 more days, it should not exceed 10 days. During this period, the additional 3 days given, the investors who have put in their bid can change their bid also. See, what is ASBA? It is very important to understand about ASBA in case if you are want to invest in an IPO. ASBA is a very fancy word. I will make you understand this. See, ASBA is nothing but application supported by blocked amount. So, AS means application supported, B is blocked, A is amount. What does it mean? Whenever you put in an IPO application, you are giving an authority to the merchant banker to block the amount based on your bidding amount into the number of shares which you have bid in the bank of your bank till the time the IPO is released. I hope you understood that. See, whenever you make an application for an IPO, you are giving authority to the merchant banker. Suppose you have made a bid for 100 shares costing 100 rupees. So 100 into 100 is 10,000. Rupees 10,000 amount will be blocked in your bank account till the time the IPO is disclosed about its allotment. Now, what is the minimum bid lot or amount? See, the minimum SEBI mandated amount is about 10,000 to 15,000. Investors can give a price to bid or use cutoff price as the bid price. So what does this statement mean? See, suppose if the cutoff price, there is an option to use a cutoff price as the one of the option for issuing shares. Suppose you want to subscribe for 100 shares. Now the option given is price band of 100 to 150, and one more option given is cutoff price. All you have to do is select cutoff price. Don't select any bid amount. So any IPO aspirant who is applied for IPO, if we tick the cutoff price, then there is 100% chance that the shares will get allotted to him. If the issue is oversubscribed, just in case, then proportionate amount for successful bidders above cutoff price, they will get less share than what they bid for. It is quite obvious. Suppose you have clicked the cutoff price as the bid price, and the issue is oversubscribed. Generally, you will get less shares. However, if the issue is undersubscribed, then everyone who has applied for the IPO will get the shares. See, companies can also issue debt securities by making an offer through prospectus. Debt securities or bonds are regulated by the Companies Act and SEBI Regulation 2008 and Securities Contract Regulation Act SCRA and RBI Regulation. Now, what is the procedure? See, any company listed as a public limited company can issue, and they should appoint a lead manager, issue a red herring prospectus, and the debentures issued should be mandatorily listed on stock exchange. Debentures or bonds, whatever you call. See, issuer should enter an agreement with depository. Issuer means company should enter an agreement with depository for dematerialization of the security. See, this is a new concept which has come up. Previously, everything used to be on paper. Now, every issuer has to enter an agreement with the depository for converting their issue, whether it is an IPO in terms of shares or IPO in terms of bonds. It should be in the demat form only. Now, in case of issue of debt securities, the coupon payable, coupon matlab the interest payable, is need to be fixed in consultation with the lead manager. There is something called as debenture trustee. Debenture trustee, usually a bank and financial institution who are registered with SEBI, has to be appointed. See, what is the function of this debenture trustee? These trustees ensure that the property charged against debentures are sufficient to meet the obligation of the debenture shareholder. So what does it mean? See, you must understand that in an IPO, in case of shares, issue of shares, it is the ownership of a company. Whereas in case of bonds, it is the loan taken by the company from the retail investors. Hence, the company has an obligation to pay that money back. Bondholder does not have the right of ownership in the company, but however, the bondholder have the right to the property of the company. Hence, the company should say, see, I am holding 100 rupees of property. I want 100 rupees. So, hence, that 100 rupees should be held by the debenture trustee to ensure, just in case if the company, will not, or if the company is not functioning well, the company gets liquidated. Once the company gets liquidated, that assets will be sold. So any money which is received from that selling of asset will be given to the bondholders and not to the shareholders. It is very important to understand this. See, there should be a debenture redemption reserve and transfer a portion of the profits into it each year till the redemption of the debenture. So there will be a debenture redemption reserve which will be created by the company, and they should keep putting a portion of its profit to that in order to ensure that the money which they have taken from the bondholders, they should be able to pay it back on time whenever the bond term expires. Now coming to the rights offer. See, right offer is usually made to the existing shareholders of the company. See, the time period for advance intimation is 3 days, excluding the intimation and record date. See, what is rights entitlement? See, it is a concept wherein if an existing shareholder does not want a rights issue, then he can transfer it to another person who is holding the share. Also, a rights entitlement has got a separate ISIN number so that it can be traded in international exchange at current market price of any existing investor. And this concept has become common everywhere. Application has to be done through ASBA only. What is private placement in equity and debt? See, private placement is made to a select group of investors who are already holding shares of the company, like banks, financial institutions, and mutual funds. See, what are the advantages of uh, private placement? Uh, Actually, the company, see, investors are better informed about the company. That is the first advantage. The company has to follow less regulatory compliances. It is less time consuming because you don't have to follow too many government procedures. There is a requirement of SEBI regulations to be followed, however. See, a private placement can be made by a company even if it is not a public limited company. See, privately placed securities can also seek listing after following due procedures, even if it is privately placed. Now, coming to the preferential allotment. A rights offer is usually made to the existing and select shareholders of the company through preferential basis. That is known as preferential allotment. That is a rights offer. We have discussed what is a rights offer. Right offer is made to the existing investors. So and select shareholders. Even with existing investors, they will select certain shareholders of the company, and then they will give the issue to on a preferential basis. The select shareholders can be other than IPO holders, normal shareholders, rights issue shareholders, employee stock option, employee stock purchase, and depository receipts issued outside India. The pricing of the preferential allotment is done as per the SEBI norms. However, preferential allotment require a resolution passed by the existing shareholders. The most important aspect of preferential allotment is it is locked in for a period of 1 year. Hence, a person who go for a preferential allotment, who accepts preferential allotment, cannot sell the share for next 1 year. Now, what is qualified institutional placement? It is again a private placement made by a listed company. See, these are all fancy names given with slightly different variation. That's all. See, it is always made to identify qualified institutions. Who are the qualified institutional buyers? Mutual funds, insurance companies, pension funds. These are all qualified institutional uh, buyers. Share price for this is calculated based on calculation prescribed by the SEBI. Any qualified institutional placement shares sold within 1 year of the placement, it has to be made in a recognized stock exchange. Now let us understand this. This is all about the primary markets. Okay. Now let us understand what is secondary market. Any instruments uh, which are IPOs are traded in the secondary market. Uh, See, secondary market is not issued through primary market like privately placed debt or equity. See, what is the role and function of the secondary market? Uh, the first important concept of the secondary market is it helps to support the capital raising function of the primary market. So secondary market basically support the primary market. It provides liquidity. See, secondary market help in buying and selling of shares, hence it provides liquidity. Also, whenever a stock start getting traded on a secondary market, there will be price identification because there will be more liquidity will be there. See, perceptions of a number of people will get involved, and hence price identification, automatic price identification happens whenever any company enters the secondary market. The most important aspect of secondary market is it acts as a barometer of economic activity. So let us understand this role and function of the secondary market in more detail. It provides liquidity, very important. It helps in price discovery. Since crores of investors are putting their assessment and analysis, uh, price discovery will obviously be there. And third important aspect is it indicates economic activity. Most of the indices are derived from the price of various securities traded in the market of different sectors. Hence, this gives an indication of the health of the market and also the health of the economy. Hmm, See, it provides something known as information signaling. What does it mean? Any fluctuations in the share price are basically influenced by the performance of the company and corporate governance, because people will come to know about how the company is functioning. So, based on the corporate governance and performance, the fluctuation of the price happens. So, this will act as an information signaling to the existing investors. See, market for what does it mean? See, any stock which is traded in the stock exchange uh, will help the retail investor to ensure better corporate governance by the company. See, by buying or selling in the market, the company will be appropriately rewarded for its good governance or bad governance. Now, let us see the components of the secondary market. First of all, it has got market infrastructure institutions. Who are they? They are stock exchanges, clearing corporation, depositories. Next are investors. There are individual investors and institutional investors. Third is issuers. Issuers are companies. Fourth is financial intermediaries. Financial intermediaries are those that facilitate secondary market activities like brokers. And regulators, we know SEBI, RBI, a number of regulators are there in the secondary market. Now coming to the market infrastructure institution. See, market has three different phases. The trading phase, which is basically done by the brokerages in India. Clearing phase, which is done by the clearing corporation. What is clearing? It is the process of uh, what is owed by the seller to buyer in a trading. So it is an exchange. Whenever a buyer buys something, he has to give the money and take the share. A seller has to give the share and take the money. That is known as clearing. That is done by clearing corporation. What is settlement? Settlement is the process of settling the obligation of counterparties. Who are the counterparties? Buyer and seller. See, settlement usually take place 2 days in India as of now. Now coming to stock exchanges. See, stock exchanges basically provide a platform for investors to buy and sell shares from each trading member who are permitted to transact on the exchange. We know the stock exchanges. Now, important concept is clearing corporation. See, clearing corporations oblique clearing house act as counterparty for all trades executed on a stock exchange. What does it mean? See, clearing corporation, they take money from the buyer and take share from the seller and they keep it with them. So whenever a transaction happens, it ensures the buyer is given the number of share which he asked for, and seller is given the amount of money which he asked for. That is the work of the clearing corporation. So all buyers pay funds to the clearing corporation and all sellers deliver security to the clearing house. There are certain special intermediaries called as clearing members. Clearing members can be brokers, banks. These clearing members complete this transaction of getting the money and shares and giving it to clearing corporation. Clearing corporation of the clearing house complete the other part of the transaction of paying the funds to the seller and stocks to the buyer. Now let us understand who are the main clearing houses in India. National Securities Clearing Corporation, NSCCL is one. Indian Clearing Corporation, ICCL is another one, and Metropolitan Clearing Corporation. Now depositories. See, who are depositories? See, in order for securities to be traded in stock exchange, it should be held in demat form. Hence, depositories are the organization which helps the companies to convert their shares or the bonds into demat form. So every company which desires to raise money from the stock market through IPO, FPO, they have to first register with a depository, and their stocks oblique shares are converted in the demat form, and then only it can be traded in the stock exchange. So depositories, play a very important role in the functioning of the stock market. So depositories enable single point of holding of financial assets. What are the financial assets? It can be mutual fund, warrants, debentures, preference shares, money market bonds, government security. All these are financial assets. So if it has to be traded, then all these have to be in demat form. So the depositories perform this act of converting all these financial assets into a demat form. So some of the depositories are NSDL, National Securities Depositories Limited, and CDS, Central Depository Services Limited. Who are custodian? See, custodian basically function as a depository for big institutions like institutional investors. So they are basically institutional intermediaries. They are authorized to hold funds on behalf of the institutional investors like mutual funds, banks, foreign portfolio investors, etc. So they settle secondary market trades for the institutional investors. Custodians can also be clearing members. So any custodian can also become a clearing member also. Now, who are depository participants? See, depository participant, any investor who want to trade in the stock market or invest in any stock has to open an account with the broker. The broker can be a bank or a brokerage house. Uh, this is similar to opening a bank account in your bank. Some of the depository participants are bank, brokers, or institutional providers of these type of service. It is quite obvious the transfer of securities these days are electronic, and settlement of security transaction between the buyer and the seller is done through electronic form. Payments are generally made through specifically identified clearing banks. So who are the member of the stock exchange? See, investors can trade in the stock exchange only through trading members of a stock exchange, and these trading members are called as stockbrokers. Any persons affiliated with the stockbrokers are called as authorized person. See, what are the requirement of becoming a stockbroker? There are three requirements: capital requirement, qualification requirement, and net worth requirement. Any member of the stock exchange can be a clearing member or a trading member like stockbrokers, or they can be clearing members also and trading members also, and they can be professional clearing members also. So this is all about the primary and secondary markets and their components. Uh, as far as market information is concerned, I would like to discuss this market information in a separate, video, because this video will become too big. Thank you very much.